Could a value-added tax be a solution to our crippling debt problem? And is Mueller Industries ripe to go higher after its recent run?
This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Thursday, June 6, 2024 edition. I'm Justin Klein, and my objective here is the same as it is every day, which is to help you become a better investor. And normally we get right to the calls, but I wanted to highlight today being the 80th anniversary of one of the most important events in modern human history, and that is D-Day. And it was this date back in 1944 that the Allied forces began their invasion of France to push Germany back and push out their war machine and ultimately win the war. Now, the Allies were led by the so-called Big Three, the UK, Soviet Union, and the United States, which were principal contributors of the manpower. The massive military invasion known today as the Normandy landings, nicknamed D-Day. And it was targeted on the beaches in France. And today, 1944, seems like a long time ago. But in reality, many people in the InvestTalk audience probably had a father, grandfather that were fighting during that time. And I know I had a great grandfather that was in World War II. Well, not great grandfather, a great uncle that was in World War II, and he died. He was a fighter pilot. So this hits home to me, and the invasion forces at that time included 7,000 ships. Think about that, and landing crafts. More than 2 million Allied soldiers, sailors, pilots, medics, etc. And of the 4,414 Allied troops killed on D-Day, 2,501 were American, and more than 5,000 soldiers were wounded. In the ensuing Battle of Normandy, 73,000 Allied forces were killed and 153,000 wounded. Step back and think about that. It's such a large number. And it's a reminder that war is destructive. There's nothing more inefficient than war. There's nothing more inflationary than war. It redeploys precious resources, land, labor, and capital towards destruction and not production. And in the process, you also lose manpower. Those that can actually produce for countries, economies, and the world. So let this be a reminder to you that, while that was a difficult time in human history, there are lessons to be taken always, both on the geopolitical front as well as the economic front. Now, how did the U.S. stock market react? When the Allied forces invaded on D-Day, stock market barely moved. Dow rose more than 5% over the next month. And from the start of World War II in 1939 until the end in late 1945, the Dow was up a total of 50%, more than 7% per year. So, in addition, war does not have to always be a negative for asset prices. And like I said, it's inflationary. And this is another lesson. Inflation generally means asset prices go up. Because remember, the stock market is not adjusted for inflation. It's priced nominally. So this number is 7% per year. I have to go back and look at the data, but it was probably not much lower. Inflation was probably not much lower than 7%. So was the real return over that time? Probably not that great. Now, during the two worst wars in modern history, the U.S. stock market was up a combined 115%. So once again, inflation is generally nominally positive for risk assets, for equities. So hope that gave you a bit of a lesson of how to look at these news events. They can be scary, but ultimately the market only cares about the economic impact. Now, we don't live in a vacuum, so that's a bit of history, but now I'm going to talk about today's market performance, as well as run down some show topics. But first, I'll tackle this caller question now.
Hey, guys. I wanted to get your opinion on Dollar General, and if now would be a good time to buy. Just wanted to get your thoughts. Thanks.
All right, Dollar General, this has been in a downtrend really since the fall of 2022, when it peaked out around $260 per share. Now we're at $129. It is off its 52-week low, which was at $101, but its recent high was about $70, and we're just recently started to roll over. And so for everyone out there, this is Dollar General, dollar store, and you have to think about what the consumer is doing. The consumer on the low end is not very strong. And guess who shops at Dollar General? Those that are in the lower income brackets. They're looking for the bargain. If you have money, you're wealthy, you're not typically shopping at Dollar General. So this is in a downtrend. It's in a downtrend for good reason. The lower income rung of the economy continues to weaken, look poor. They do have a decent amount of debt. So no, there's nothing about this at this moment that gets me excited to buy Dollar General. So I'd certainly pass. Thanks for the call. Now we're going into a short break, and on the other side, I will run down today's planned topics and talk about today's market activity. But please remember, you can call anytime and leave your questions on the InvestTalk voice bank. If you're listening via our live stream or an AM 1220 radio in the Silicon Valley area, you can call right now and talk to me live at 888-99-CHART.
The big day is coming up fast. Click the link in this video to register for the new InvestTalk Wealth webinar. It's all happening online Tuesday, June 11th at 1 p.m. Pacific Time. You are invited to join KPP Financial's InvestTalk hosts, Justin Klein and Luke Guerrero, as they reveal the secrets of quality investing. Learn why it's essential to look beyond high dividend yields so you can build a resilient and profitable portfolio. In today's volatile market, quality investing is the key to long-term success. Justin and Luke will provide insights and strategies to help you make informed investment decisions. Reserve your spot now. Click the link in this video to register for the new InvestTalk Wealth webinar.
Now we have about 45 minutes left in today's show, and this is what we will cover, time permitting. Now, could a value-added tax be a potential solution to our crippling debt problem? One solution, but obviously we need to probably deploy many. So we'll discuss this and the fact that the Congressional Budget Office says that interest on the national debt in 2024 will now cost a staggering $870 billion, exceeding what we spend on defense. So we'll talk about the realities of heavy debt and what can be done. We also are going to discuss diamond prices. Guess what? The lab-grown market is certainly taking over, so we're going to look at that and what that might mean for companies like De Beers. Also, life insurance companies have invested in private debt in a big way, and that's starting to come back to bite them. So we'll talk about that. And then if we have time, we'll touch on the Treasury debt buybacks. And this is another one of those alphabet soups of programs the Treasury is likely to deploy to try to deal with our burgeoning debt problem. And it's important to understand because it really gives a clear picture that the Treasury has a lot of tools at their disposal. It's It's not just about QE, and they can get creative, and this is one way that they are. So we'll look at that. We also have some voice bank questions. One is on Bath and Body Works, and the other is on Clip Global X 1 to 3 month T-bills ETF. So we'll look at that. Also, we have questions that came in via the comment section over on our YouTube channel. And of course, your investment questions are top of mind for us. So if you have one, give us a call at 888-99-CHART. Now let's pivot back to the InvestTalk Voice Bank. This is where you can leave your question in your own words. So I'll play a question and then give my answer.
Hello, this is Jim from San Diego. My condolences to Steve and his family. I had the privilege of meeting Steve and talking with him, and he's going to be greatly missed. I was wondering if you could take a look at CLIP, C-L-I-P. I have about 35% of my portfolio in that as a so-called safe haven. I'm 68 years old, and I'm just wondering if you think that that's too much to have, and if I should have concerns about the debt, because the CLIP is about T-bills. Thank you for all you guys do. I appreciate it.
Well, you should be somewhat concerned about the debt, but not in this instance, not with 1 to 3 month Treasury bills. Obviously, the government is going to make good. We've said this many times. The government is not going to nominally default on Treasuries. They will attempt to default through inflation over time. That's the path forward. And CLIP holds a bunch of short-term treasuries, 1 to 3 months. Its expense ratio is 7 basis points, which is pretty good. We use iShares has a similar one that we use for some cash for our clients. Let me see. If I remember, it was also 7 basis points. Let me pull that one up. But both of them are the same. Yes, the iShares, it's 0 to 3 months, so kind of same thing. And that one is same thing, 7 basis points. So, you're splitting hairs here. The effective maturity is slightly longer on CLIP, but not, you're talking a difference of days in duration. So effectively the same. So either one works, to be honest with you. I have no problem with this as a cash alternative, a money market alternative, something that will maintain its value for sure, and pay you that 5.25% yield. Now remember, the Fed does cut rates coming up, then this will feel that immediately because there's no duration in the portfolio. So understand that as well. Okay. So that was CLIP Global X 1 to 3 month T-bill ETF. Thanks for the call. Now let's take a look at the market today. It's a modest down day. Large caps were broadly flat overall. You had the SP was down about 1 point. Small caps did the worst. They did not do the worst. Mid caps did the worst. They're down about 40 basis points there. Small caps are down about 30 basis points. And if you look at what were the big movers, GameStop did have another good day today. Same with AMC. So that kind of Reddit trade is still hot at the moment. It'll probably fade at some point, but that's certainly kind of keeping markets up right now. Nvidia was down a little bit. NIO was down. Tesla slightly up on the day. And we get the jobs number tomorrow. That's really what I think the market was kind of wishy-washy today. You have a big jobs number tomorrow. You've seen some indication that the labor market is weakening to a degree, but you'll get more color tomorrow because we'll have a lot of jobs numbers. So that's what is on the dockets coming up. And gold did well. That had a nice day. Maybe that's telling you something about a weaker jobs market. The dollar was weak as well. Okay, let's see. The yen was stronger. So that was interesting. And then what did interest rates do? The 10-year rate, that was down slightly. Once again, kind of waiting for the jobs number for tomorrow. Now we're going into a short break. Still to come, answers to caller questions, and I will get into my main focus point. This is InvestTalk. We enjoy your voice bank calls, but we also love your live calls. So get your question in right now at 888-99-CHART. Love today's InvestTalk episode? We want to hear from you. Drop your investing questions in the comments below. and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by Luke and I. Dive into the comments now and become a part of our next conversation. Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors. (888-99-CHART), 888-992-4278. And today's main focus point is about ways to deal with rising debt, our rising debt problem. This year, the Congressional Budget Office says that the interest on our debt will cost us $870 billion, exceeding what we spend on defense. And defense is the largest discretionary item in the budget. And 1/3 of what Americans pay in income tax goes to servicing our national debt. Think of that. 33 cents out of every dollar. Now, this is frankly a bipartisan effort. Something that, Republicans in the past have talked about being deficit hawks, but no more. It's just more about how they want to spend more and borrow more. So it's hard to get too political on this. Both are to blame. The question is, when will Congress address the issue? Because it's Congress. As much as everyone wants to, and I see this a lot, is they blame the president at the time, right? If you're a Democrat, you blame Trump. If you're a Republican, you blame Biden. But the reality is, especially on spending, that comes from Congress. Yes, the president can push and have their sway, but at the end of the day, it's Congress's job. So when will they deal with the issue? Well, if history is any guide, it will be when there's some sort of major crisis. That's just how we work. Right? Was it Churchill who said that Americans will do the right thing, but only when they're forced? I forgot the exact quote, but something like that. When they're forced to. And we typically do. Now, what will be the catalyst? Will it be a bond market that gets dysfunctional? I think that's probably it. But we know right now the Fed is, and I'll talk about this later, is doing what they can to quell any dysfunction within the bond market. But the Congress can't do anything about that. But what they can do is change the laws. And I think there's an underappreciation of the levers that can be pulled. I see this a lot with Social Security. Everyone's saying Social Security is going to run out and all of this. And yes, that's true, but there are minor changes that need to be made to make that Social Security system solvent. Means testing, pushing back the age of Social Security a little bit, full retirement age, changing the cap on withholdings for income for Social Security, etc. So there's a lot of things that could be done. I'm not saying which one's a good prescription. But another one, besides cutting spending, which nobody, and that's really the main issue, is that nobody in Congress really wants to cut spending. Because it's hard. The mandatory obligations, talking Social Security, Medicare, and Medicaid, were $3.8 trillion of a total $6.1 trillion budget. So pretty much 2/3 of the budget is non-discretionary. They're mandatory obligations. So unless you want to truly cut Social Security, truly reform Medicare and Medicaid, that's not going to change. And then you have $1.8 billion of discretionary spending, and we said the defense is about $800 billion of that. And then you have national debt. The interest in the national debt. So the main way to do this would be to increase revenue. Now, nobody likes to see their taxes go up. And the main fight is typically on income tax. But a very common one, especially in other countries, is what is called a value-added tax. Now, we pay sales tax, and that's typically how tax on goods is collected. But value-added tax is something that's practiced in most countries. It's very common. Now, the CBO estimates that a 5% tax of this kind would raise $3 trillion over the next decade. And yeah, it would be inflationary, probably. But it would be broad-based, and it would spread the tax. So you could lower sales tax and replace the value-added tax. And basically, value-added tax is a tax at each stage of production. Right? When when the raw materials come in, that's taxed. When the manufacturer builds a widget that goes into another product, when that widget is sold, that's taxed. When the final product is finished, that's taxed. When it shifts to the retailer, that's taxed. And then you get a small tax on the end for sales. So it's throughout the chain, and there's different ways to construct it. But that's the thought process here. But it's important to highlight this because there's so much. I continue to talk about it. Bear porn out there in regards to the debt situation, but the reality is that the powers that be, right, in Congress, the government, the Treasury, the Fed, they have tools to continue to kick the can down the road, make small changes here or there to sustain the system. And there's going to be pain involved. Yes, absolutely. And there's change that people need to get used to. But to say the whole system's going to come crashing down like a lot of people on social media want you to believe, well, the reality on the ground is far different. Now, in the next Invest Talk, we'll look into this story. Maybe you don't have to follow the lauded financial guideline rules. If you understand your goals, you can discover which protocols can and can't help you achieve them. That story tomorrow, but for now, I'm Justin Klein. I'm ready to take your calls at 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast.
Do you want to be a part of the conversation? Don't forget to comment below so we can answer your questions on the next InvestTalk podcast.
Let's go talk to James in New York looking at Civitas. You own it or looking to buy it?
I own it, and I'm thinking of adding to it. I don't know if maybe this is a good level to add to it, or shall I wait for it to dip a little lower?
Well, it's going to move with the energy space as a whole, and obviously energy's pulled back as of late. There was an inventory number that came out where inventory swelled more than expected, but you kind of want to look through those short-term market movements. And yeah, I think this is it's a company we own for clients, and this we've been picking up since around the beginning of the year. And like I said, it has pulled back, hit a high around 78. Now it's at 67. And they're supposed to make $14 per share next year, and analysts continue to upgrade that number, and it's a $68 stock. So we expect, this is a good name to own. It's obviously higher risk because it's a small to mid cap name, about $7 billion market cap, and they do have some debt in their balance sheet, but it is a company with very good assets and very good cash flow. So I would think about picking up more.
Okay, thank you.
Thanks for the call. Now, we just talked a little bit about what Congress can do about the debt situation, but what about the Fed or the Treasury? And there's a recent launching of what's called the Treasury buyback program that is designed to help improve liquidity in the government bond market. And that's really what I think the Treasury and the Fed want to avoid, is a disorderly bond market where prices jump and they move rapidly. And there are different tools. We talked about how last spring, when we had the BTFP program that was launched in order to help banks not have to dump their treasuries, allow them to basically offload treasuries that were underwater, trading below par, and keep their balance sheet solvent. And so they don't have to fire sale assets. But what this does, and this is something they actually did for a couple of years back in the early 2000s. And what this does is allows them to buy what are they called off-the-run securities. So off-the-run securities are those that have already been issued and they're just trading out there in the marketplace. And obviously there's a lot of treasuries like that. Now what they're doing is saying we will buy back up to $30 billion a month, per quarter, of these bonds. And what this is allowing them to do essentially is to buy back bonds at a cheaper price. I actually think this is very smart. Something the government should do probably a little more often, which is they are strong hands. They can hold forever, right? And in the case of these bonds, when they buy them back, they're taking their debt off of the market. And they say, where does this money come from? Well, what they're doing is they're typically buying longer dated securities, and they're typically below par. So they can go issue new debt, short-term debt, and then go buy back, and say at $100, right? 100 is par. They can buy it at 100, sell debt at 100, and then go buy back longer-term debt below 100. And they're effectively arbitraging that. They're able to create a gain there, effectively. Now, the first buyback took place this week, and they expect to hold weekly purchases with caps of, like I said, up to $30 billion per quarter. And they even say they are price sensitive. So they're not just buying back any bonds. They're trying to buy back bonds that are a little bit less liquid and below par. And so this is one of those other tools that the government is going to continue to utilize to keep things, to kick that can, right? To not face the debt situation. Now, ultimately, it will come to a head, yes. But as John Maynard Keynes says, in the long run, we're all dead. So it's something that you have to take with a grain of salt when you see those posts about how everything's going to hell in a handbasket. No, when the problems really arise is when those that have the power to solve it are not paying attention. That's what happened in 2008. Right? The subprime crisis is contained. They obviously weren't paying close enough attention to understand the problem correctly. In this environment, the government sees the problem. Now, at one point, they may not be able to fix it, but that doesn't seem like it's in the near term. Now, I hope you've been telling your friends about the InvestTalk audio podcast and that it is also available over on our YouTube channel. And every day we get comments and questions. And so let's tackle one of those now. It says, I'm interested in buying KNSL, which is Kinsale Capital Group. What would be your price target to be on it for a buy? Okay, Kinsale Capital Group. Let me just pull that up here. It's a mid-cap name, $9 billion market cap. Earnings next year is supposed to be nearly $18 per share on a $388 stock. Low 20s forward-looking multiple. And what they do is they provide property and casualty insurance coverage in 50 states. And we've always said the insurance market tends to be fairly boring, but I tend to like P&C companies. They tend to have consistent revenue, consistent cash flow, consistent earnings. And this is a name whose cash flow continues to go up and up and up. Continues to make new highs year after year. Return on equity is at 36%. That's very good. Return on invested capital, 30%. Also very good. Now, what I would say is this is near an all-time high in profitability. Is that profitability mean reverting? And could that be potential reason for this to have a setback? Yes. It has already had a bit of a setback, gone from $500 and roughly $50 per share in March at its peak, and recently hit a low around $355, and now it's at $388. Near term, the technicals are meh. It's below all the major moving averages. It's just been consolidating this recent drop from April. And so I would be patient on it to get back above the 200-day moving average. Until then, I would just keep my eye on it. I like what you're looking at. I like the profitability. I like the type of business that it's in and its long-term consistency. I like all that. But the technicals right now are just a bit too bearish for my liking. And I would need some sort of momentum building to the upside. Right now, the momentum is to the downside. All right, let's keep pushing forward with more listener questions. This one came in earlier from Ohio.
Justin and Luke, thanks for everything you do. Chuck from Clayton. Hey, I'm looking at Mueller Industries, MLI, Mary Lincoln Ida. It's about 3.5% of my portfolio. I like it because of the minerals industry. But as I'm looking at it, I got one site that's telling me they're going to drop earnings per share this year, and another site telling me it's going to go up. I know they just acquired a company like Nehering or something, and I'm wondering if that has something to do with it. Anyway, I want to get your idea on it. I was thinking about adding more of it to my portfolio, but wanted to get your idea on how this company does. Thank you very much.
All right, this is Mueller Industries. It makes copper, brass, aluminum, and plastic products, mainly 3 business segments: piping systems, industrial metals, and climate. So this is mainly in the HVAC system. Think of that type of business. And it's a very good business, especially post-COVID. Earnings have exploded. Stock was trading around $15 around COVID time. Now it's at $56. Earnings were around $1 per share pre-COVID. Now we're pushing with $5.30 last year, but earnings are expected to drop 15% this year to $4.50. So it looks like things are beginning to revert lower. It's just a matter of where does that level out at. Now the technicals are getting a bit toppy here. I'm starting to see some weakness. I would probably use this opportunity to trim back a little. I don't like the recent momentum waning, because there's a lot of probably weak hands in this name that have been riding this up. And this looks to be a name that should settle back into the mid-40s while the market waits for a clear picture of where long-term earnings will be. Are we headed back to $1? Is $4 to $5 realistic? $4 to $5 realistic over, the next 5-10 years? It's probably still pretty cheap. If it tends to move back towards $1 to $2 per share, it's very expensive. So that's what's hard about some of these names that had a very different looking business pre-COVID and now are looking like rock stars. Is that sustainable? I think in some instances it will be, in others not so much. So you wrote it up. You're doing nice with it. I'd probably take a little chips off the table and watch it for signs that this level of profitability is sustainable. Now let's play 2 calls in a row now.
Hi, Justin or Luke. I was wondering if you could take a look at ticker symbol THC, Tenet Healthcare. I'm looking at some more exposure to the healthcare sector. I don't have much right now. The company has run up quite a bit as of late. Maybe the PE looks good now, but forward PE looks like it's a little bit higher. So you could take a look at the numbers and let me know if you think it is a good company, and if it pulled back to a certain price, if you think it would be a good buy. Thank you very much. Have a good day. Bye.
Are looking at Tenet Healthcare, and they operate 61 hospitals and 164 outpatient centers in urban and rural communities in 9 states. And this is a very interesting one, and it's moved up pretty far, pretty fast. It's bottomed last fall around $50 per share, a little higher, 52, and now it's at $134 per share. So it's nearly tripled in just about 7-8 months. And that's because earnings are expected to go from, and this is a perfect example of one of those names that, earnings dipped down, but they certainly could reaccelerate. In 2020, as you imagine with COVID, they're in $7.92. That was an all-time high. Dipped down a little bit in 2021, still nice, $7.58, and then $6.80, and down another 10% in 2022. You saw a little increase last year, up to $7 per share, but this year it's expected to make $8.70. And we know with an aging boomer population, a lot of issues post-COVID and post-vaccine for a lot of people. There's a lot of people going to hospitals, and so this is a good business. You're barking up the right tree. The question is on timing. Is it really worth that much? That they do have a lot of debt on their balance sheet. Yes, free cash flow has boomed. Return equity is up to 46%. That's very high. And near term, it's very overbought. So I like what you're looking at, but I think you've missed the boat on this. Things need to come back in. You need a significant pullback to get this into a healthier technical position. Not that it's completely unhealthy, because it is at a 52-week high. It's just too overbought and a bit overpriced for my liking. Because even if they make $9 per share next year, you're talking about a 15 times multiple. And, how sustainable is that when they made less than $3 per share pre-COVID? So I'm keeping an eye on it, but I'm not pulling the trigger on Tenet. Thanks for the call. Now let's touch a bit on the diamond markets. And this is coming to the spotlight since Anglo American is trying to fend off a purchase from BHP. And Anglo American owns De Beers. Yes, De Beers Diamond Company. And they're looking to sell it and reinvest the proceeds into other raw materials. Now the question is, how do they do it? And what is it worth? And it's very difficult to say because of where diamond prices are headed. They're headed lower because you can make a diamond in a lab. It's the same molecule as coming out of the ground. So why pay up? And many, many people are doing that. Rough diamond prices are down 17% in the last year. And that's after steadily falling for the past decade. And mining diamonds is very capital intensive. $524 million in CapEx spending by De Beers on average in the last 6 years. So how are they going to get rid of it? Most likely an IPO, because they have the brand name, and they can sell the story that they're going to cut costs and that diamond prices will recover. But there's a lot of hope that that EBITDA will rise dramatically from last year's number of only 77 million. A lot of people are saying, hey, we can get back to 900 million in just a few years. I think that's a little bit pie in the sky. So just a little update on the diamond market. And if you see a De Beers IPO, be very skeptical, especially if the price is more than a couple billion. It's probably not going to be worth it, but they'll probably try to pump the value and get things to look rosier in the near term than they actually are. Now we're heading into our final break. I'm ready for your calls now at 888-99-CHART.
Everybody wants a secure financial future, but getting there takes strategy, discipline, and the right information. Welcome to the InvestTalk podcast.
Thank you for watching. Make sure you like, subscribe, and hit the notification bell so you never miss an episode of the InvestTalk podcast.
remind you that the KPP Financial InvestTalk Wealth Webinar is just a few days away on Tuesday. It's called Quality Investing, Digging Deeper Than Dividends. It's all new and it is free, but you must sign up. You will gain valuable investing insights and you'll even be able to participate in a Q&A session. We're going to focus on keep the presentation relatively short so we can make sure to get to that Q&A session. And it all happens online on June 11th from 1 to 2 p.m. Pacific time. But once again, you do have to register by heading over to investtalk.com. Now let's play one more question now.
Hi, Justin and Luke. First, condolences to the Peasley family and InvestTalk family. We're going to greatly miss Steve and hope everyone's doing well. My question today is about H&E Equipment Services, Inc., ticker symbol HEES. It has dropped into my buy point, but I'm wondering what you guys think of the company. Is this a good time to buy or just keep it on my watch list? Looking forward to hear your insights on this company. Thank you so much and take care.
Well, thank you for the kind words on Steve. And for HEES, that's H&E Equipment Services. And as the name would imply, this is an equipment rental company. They rent out earth-moving equipment, industrial lift trucks, cranes, etc. But it is a volatile name. Back in last spring, it fell from $55 all the way to $33 in just a few months. From, that was early March to early April. Or early May. You're talking about 2 months. It fell dramatically. And it's done that again. From $66 per share, now we're down to $45. And that 66 number was just in the beginning of April. So once again, 2 months, it's fallen pretty dramatically. But every time in the past, it's pretty much turned the other way. And I think you could see that again. I like the business. It's obviously very expensive, as you would imagine for a small cap name. It is a small cap name, $1.6 billion market cap. But history says it's volatile, but volatile to the upside. So I'm going to give this one generally a thumbs up. Return on equity is 34%. Now, history says, can dip negatively, which it did during COVID. But history says return on equity is usually between the mid-20s and the mid-60s, which is very, very high. Now it's at 35. So it's kind of at the midpoint there. So if you're willing to take the risk, if you're okay with that risk and that volatility, go for it. But go in with your eyes wide open, because this could easily go from here, even though it's at support. I will say that around this $45 level. Today it's trading at $45.01. Could go all the way down to 33 very easily in the near term. But once again, I like the business. So I'm going to give HEES a thumbs up. Now, lastly, let's touch on a report coming out of the Chicago Fed. And they are warning about the level of private placements that are held by life insurers. Mainly companies like New York Life and Apollo Global. They're the ones that have the most exposure to these private debt securities that are high risk. They're high return, but they are high risk. And it's something to be aware of when you're looking at a lot of these life insurance companies, because I think that's where the poor lending happened. I think one of the reasons why credit spreads in the junk bond market right now are so tight is because that market has actually shrunk as a percentage of the overall economy. Why? Because these private lenders are soaking up a lot of the lending. And there's not a whole lot of clarity to how good these actual debt instruments really are. And so if you're looking for a place where there are problems hiding underneath the surface in parts of the financial market, it's probably not the banks, to be honest with you, the big banks. It's actually in some of these life insurers. So just be careful. Don't go overboard. Not to say you don't buy a life insurer because of it, but do your due diligence on their holdings of private debt. No, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play, and be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.